Hello, this is David again. Today I'm speaking in English because there are some people who ask me if I can speak English sometimes that they don't understand nothing in Korean. So I decided to speak English today. And then today's discussion, I really want to talk about the stock market because I've been, working in this industry over 20 years, and I want to share my idea and thought with you. Today's Good Friday. Good Friday is usually market is closed, stock market. I have free time to do this. Um, uh, we today I'm discuss the three things. First, the stock market, new IPOs, what's going on, why this happened at the same time. Too many companies going to public and simultaneously. Why is that? What happened? What's the uh, things behind the scene? Things like that. And the second. We're discussed, the current, uh, the market leaders, so that you may understand, what companies doing what, and so things like that. And the third, I'd like to discuss a little bit about news trend for compared to 2008 subprime mortgage instant, and then so the differences between today and the 2008. So first of all, yesterday there are two companies that went to public. One is Pinterest. The other one is Zoom, the video conferencing service provider. They're Pinterest, for example, at $12.3 billion market cap already. The stock prices went up by 25% yesterday. Then Zoom as well is more than mid 50, $60 per share. This is the only company who are profitable at pre-IPO stage. So there are many companies that are backing financially into this company before they went to public. And a few days ago, Lyft went to public, was $32 billion market cap already. So, and then it's not the end of the story. There are dozens of companies will public. Airbnb, the next big thing is Uber, and everybody knows that Uber already. And then Robinhood, free online trading, stocks trading service companies. That we're talking about $6 billion market cap, and then Plantiers at $30 to $40 billion market cap. We're expecting, and the WeWork is going to go public the first sometime mid 2000. Sometime first half of 2019. We're anticipating about around $42 billion market cap. Yeah, so many companies going to public this year. The people are really investors. There are some investors in my peer group. They're concerned about the fact that there are too much money going into the stock market. They're concerned about overinflated market. But the way I see is a little different. The reason is, number one, these companies are not one of just companies going to public. The companies, majority of the new IPO companies, including Ubers and Lyft and Zoom and Postmates, they are making a new industry. So here's the reason: the way we live is dramatically changed from 20th century mindset to 21st century mindset. That's the 2018 and 19, what we're living right now. The people have a tendency to forget the benefit of innovations. Apple phone, for example, how easy that transact with the people, the way we communicate with the people using text messages and emails. The way we do business, so using iPhone only to shorten the productivity. For example, like when I was working for Merrill Lynch, when you make a trade, it took at least 3 hours. You call your client, it's got approval from the client. Sometimes you need a written notification, you written authorization. Yeah, I need the permission to trade this certain stock ABC, and then got approval right next day. Sometimes 2 to 3 hours take, and with a written approval, I took it to my compliance officers and needed another approval, internal approval with that transaction. Then once approval, you click buy and sell, exact a certain amount of money, and that not a dollar difference in that specific share price. But now I'm doing it within just one click, 2 to 3. I got authorization from a client using iPhone. He just yes, and boom. Within 30 minutes, it took me half day into just 30 minutes. That productivity, these companies are providing those productivity. The way we own the vehicle, automobile is different. You don't need automobile at home. In urban area, you don't need a car. You just, call the Uber using your iPhone, whatever phone you have, your smartphone. They come in 5 minutes. You don't need to hold your spot, your parking spot, which costs sometimes $100 or $200, $300 per month. That's the companies are providing, and the self-driving cars. We're talking about the delivery in 10, 20 minutes. Sometimes the future, I think, is a McDonald's. And you can order online at McDonald's. The delivery using the services Postmate will, your McDonald's number 9, number 10 in hamburgers, Happy Meals, right in front of your front door. Within 10, 15 minutes. That's what's going to happen. The services they're providing. So these are the company who are making the industry, okay, not trying to become another competitor. Well, there are competitors, Uber and Lyft, but they are building a new industry, from the old-fashioned way to the future, or I call it futuristic companies. That's what investors are really into this area. Usually in the Silicon Valley where I live, for example, Uber, how much money they raised before the IPO? $7.2 billion already. The major company, Google, Uber investors, Google, $258 million, and Goldman Sachs, $1.6 billion, Saudi Wealth Fund, $3.5 billion, SoftBank, $1.3 billion, Toyota last year's $500 million. These are not the stupid people. These are the very savvy, thoughtful investors. They are confident that Uber will make a new skyrocketing industry. They're gonna make that happen. So I know some people are concerned about overinflated market. There are some overinflated sectors, There are some concern about the the new the companies that are not doing well. For example, let's Boeing 737 Max. It's really I'm really sad about that story. You compare with Boeing 737 Max equivalent airplane. Its major competitor, Airbus. I'll talk a little bit about that thing first. I mean, if I really want to share the information with you, hopefully you're not aware of what happened exactly. So Boeing is losing the market in the 737 industry. In terms of their gas mileage is compared with the 737. I'm not quite sure the model name of Airbus. Airbus is taking off. The sales is going up because of that. Airbus 737 equivalent model, the height is, I think it's about 6-7 meters feet higher than that of Boeing 737. So what Airbus did is that they're making bigger engines so that they're put under the wings. So because they're taller, they have a room to do it. But Boeing 737 Max, they don't have that room. The way they innovated is that they actually make the bigger engine over the wing. So the part of the tip of the engine goes above the wing wing there, so that when you take off, usually that makes the nose up here. So it is with using software they try to push it down using So I think that's not a great idea to compete with their competitors. It's not possible technically. It's something. It may be possible, but they have taken a lot more risks, so that they need software is sometimes it's not working properly. So it's not when you fly on the air. Once you have some little hiccups in the software, it gives some misinformation, so that the system said, hey, you have to put your nose down and nose down. That's exactly what happened. That we lost so many innocent lives in the African company. I don't remember that. The reason here's the reason. They're not looking at the client, at the customer. They're looking at the competitors. It's a bad idea. Really, I did my MBA on the first basic 101. You have to satisfy your customers' needs and wants, not the competitor. Just basic 101. Yesterday there was a David Rubenstein show. There was a few guests. One of them was Apple's Tim Cook, and the other guy's Amazon, Mr. Bezos. Mr. Bezos said, you don't look at the competitors. You have to look at your customers, what they want. What they want is a free shipping within 24 hours. That's what happened. If I were him, I wouldn't make who's that the career what is that it's extremely difficult in the United States, in this country, to make it happen. Many years ago, before Amazon, do you remember that when you order online, you're gonna get charged at least shipping costs, right? Handling fee. right? We have a handling fee, and on top of the handling fee, there's a shipping cost, and it's gonna take at least 4 to 5 days. You expedite it, maybe like 2 days. You have to spend a whole lot of money on that. But when you order something like furniture, it's gonna take 6 to 8 weeks at least, right? Now, even if you order online your furniture, 2 to 3 days, that's free shipping. That's what the value of the Amazon. So you're talking about Amazon and working with the UPS. UPS is just physically the old-fashioned way. They deliver things, on time. That's it. But how do you mobilize those companies to ship it within 24 hours? That's, for me, that would be impossible. But Amazon create the value, what really customers want and needs. That's what you need. That's how we see that Postmate value, which is $1.2 billion. Like I said, you can order online your even like a McDonald's, they're gonna deliver you almost free, or like $2 to $3 per. That's where we're living. We're living in a complete 180 different age of innovation. You compare it to the centuries. Even 2008, what happened is what happened 2010, 11 years. The stock market in 2008 now is almost more than triple. A few weeks ago, there's psychological glass ceiling, which is 2,800. But it went through, and now it's 2,900. It's almost like 3,000. We're talking about. It's really. I talk with I haven't watched that David Rubenstein's talk show with Powell. Mr. Powell said that by the end of this year, we're not going to change a whole lot, but we're going to maintain that the dovish, slow rate change. Maybe next year. We don't know what's going to happen, but for sure we're living in a very different times compared with 2008. So that even though some people may concern, we may be might have to be fearful, when market is too greedy, just like Warren Buffett said. But I wouldn't worry too much about what's going on in the market right now. So that's my story. First story I want to share with you, and then secondly, it's what's going on in the private equity industry, who the investors who are making these companies the public, Google, for example, Google and Atlassian. Atlassian is heavily invested into these two companies, Ubers and Zoom, that went to public yesterday. So Uber is a major client. It will be Apple and Google's the video conferencing or text messaging within their companies. I think their B2B strategy, but I don't know. I'm not quite sure 100%. But it's usually I can see. I want to show you one thing here. Not here, this way. Okay, I'm going to show you here. Can you see it? So this is the the company last couple of years they went to public. You can see that three different circles. One blue dotted line here is the valuation at the pre IPO, and then the sand color here is the circle is at IPO, the valuation, and then the blue circle here is the rate when they raised the fund. So these are the companies who were making they received investment from private equity firms, VCs, and companies like Google's. So DocuSign last year, they actually how much was they raised? I think it's 990. No, 440 million dollars they raised before IPO, and they raised about I would say $4 billion, about 10%, right? So in other words, the rate of returns is 10 times, 1,000%. The companies and VCs who invested into this company pre-IPO, they made 10 times rate of return. You can see the lift here. You see that a few days ago? This is the company they invested this much, but they made this much here, right? Pinterest is the same thing. Only Zoom here, right? So, as you can see here, Zoom is the only profitable companies of pre-IPO period. So these are companies that they invested here, this much, but they made this much, all right? The companies who invested in the company before IPO. So this is a new trend? No, this is not a new trend. In financial market and especially the VC industry, their failure rate is it depending on the performance of each company, but it's usually 75%. In other words, you made an investment of 4 companies, you only make profitable or break even in 1 out of 4. There's a lot worse than that, but usually on average about 25% success rate. I would say break even is successful, so that when they make a company, their portfolio company to public, they have to make around 10%, 10 times, so that they make it all their portfolio make it profitable. It's a new trend. It's not a new trend, but it's usually more than that. That's how they make money. But this part is my concern. Warren Buffett said, when people are fearful, you become greedy. When people are greedy, you're fearful. But I really ask myself, if you're a VC firm, how do you value private companies in their portfolio? They're heavily using their discount cash flow, which means these companies have become generating a lot more revenue in the future. They discount back into the present value. That's the way it is. Even public company they did it. I know how to do it in the private sector. Because I did it from the beginning. I did my VC private equity for many years from my early career. So who's going to take all the burden if you purchase $70 per share and then all of a sudden everybody knows that it's not that valuation is not right, and they went down 20 to 25%. That's exactly what happened to Lyft, and that's what happened to I don't know what's going to happen to Pinterest and Zoom on Monday, but you have to realize that when you make an investment into the new IPO fresh companies, you have to see this is profitable enough, or in the future, there's no background or foundation of making a right decision on a new IPO. So you're the beginners of the investment. Don't make an investment from the beginning. So you need a portfolio. There are many companies who are making profit. They have a better cash flow, and I'll show you one picture here that I made myself. I'm proudly present to you. You see that you don't have to invest in only brand new companies. There are so many unsung heroes here. This graph shows that the first. By the way, I really learned that there are so many different kind of analytical tools, but I see only three different things: a fundamental analysis, which is you look at the company's balance sheet, income statement, cash flow. The second, you see the technical graph goes down at the volume, the moving average, and then third, you see quantitative analysis. Amongst these three things, the most important decision maker for me is the fundamental analysis. There are so many ways that you don't understand. I don't have much time to discuss about that. The cash flow. You see cash flow. It's just like a household. You have let's say you have a job, but you spend more than you earn, then you most likely go bankrupt. Same to the companies. You need to maintain the certain cash flow. That's how in the in financial market, that's how you stress test has been conducted. You hold your own money, certain pay off your interest rate more than good enough to pay off your interest. Compared with the borrowing money, you need a certain cash money in your pocket in order to maintain your business, maintain your household. It's the same thing with the companies. Compare with your free cash flow with your revenue. So you make money, and then you need a cash flow, right? So and then the second thing I'm really concerned about, really looking at their balance sheet is the return on equity. The asset minus liabilities and return on equity. You don't have the positive return on equity, so you're not doing well. So that's how we compare that. So the left or upper right hand side of the companies are outperforming, right? So I want to share with a very important graph here. You take a steel shot, you can use it in my portfolio. Okay, so there are hidden hero. They're making profit, and for the last 10 years, they're growing gradually. So you make money out of the stock market. There are so many companies who are not singing in front of the stage. They're behind the stage. They're working hard. They try their best, and they're increasing their market shares. So there are so many companies in the S&P 500. They're doing well in the stock price for the last 10 years. You have to take a look at those companies too. So I don't know where you're coming from. If you are coming from a Bay Area, you're too much into the technology and innovation, but still there are some companies, traditional companies that are working very hard to make their investors happy, just like this. So the bottom line is that your stock market, especially majority of the S&P 500 companies, they are doing well, they're selling well, they maintain their businesses. I'm feel positive about what's going to happen by the end of this year, some people are concerned about the recession. I don't see macroeconomy. I don't see any signs, even a sign of a recession. There are many, I can compare. You have a certain signals that you can anticipate. Recession is coming. For example, your federal fund rate, the big gap between federal fund rate and treasury bill, you most likely 75%, 80% chances recession is coming in the next quarter. It's a mixed signal there. If your treasury bill, compared to 2016 and 2018, the longer term, the rate of returns goes down, things like that. So, but there's tons of information, but I would say at least by the end of 2019, there's no recession. Most likely, there's no recession. So, I feel confident that the market 2019 is going to be at least moderately good. Some portion of the industry, which high-tech industries, will take a lead by the end of this year. Thank you for listening. Any questions, just let me know. Thank you.